The broadcast is now starting. All attendees are in listen-only mode.
Hello, very good morning to all and welcome to today's Daily Dose of Market Insights. My apologies for a slight delay due to some technical hiccups over at our end over here to get the GoToWebinar running. So very good morning to all. Welcome to today's Daily Dose. I'm Kelvin. Today will be Tuesday, the 10th of September. So before we start our Daily Dose, let's have a quick look at the disclaimer first. Alright, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Alright, so with that, let us have a quick recap of what has taken shape yesterday in terms of the respective news flow, economic data release, as well as is there any important data release this morning earlier before the start of our daily dose, and as well as their impact on the respective cross asset classes. So as we know that yesterday during the European and the US session, there was actually a very light economic data calendar, no impactful high level macro data that could actually shake the intraday performance of the major cross asset classes, for example, the major US stock indices. So yesterday, major US stock indices has been primarily driven more on technical factors and flow factors. And those who follow our daily dose of market insight yesterday, we were actually kind of highlighting there's this prospect of a mean reversion rebound that could take hold in the major US stock indices after last week a dramatic decline in the broad-based US stock indices that saw a rather lackluster performance, where the S&P declined by negative 4%, the Nasdaq down almost negative 6%. So that was their worst weekly performance since October 2022 and March 2023 during the onset of the US regional banking crisis then. So that actually came in within our expectation, I would say. So all the broad-based major US stock indices ended in the green yesterday, with the SPX up positive 1.16%. The Nasdaq 100 outperformed together with the Dow Jones Industrial Average up 1.3% and 1.2% respectively. And also the small cap Russell 2000 managed to lock in an end of day gain of 1.13%. So if you look at the heat map of the S&P 500, all of them managed to close in the green entirely for the majority of the sector. All right, over here, so only a handful of them we see rates over here, rates. So one to highlight here is the mega is only one of them actually so rate, which is Alphabet, Google down negative 1.7%, and Apple very lackluster, almost unchanged, with just a minor gain of positive 0.04% after the March fanfare of this key Apple product launch event was actually that has taken shape yesterday during the after the first half of the US session. So that is after 12 in Singapore time. So what market is actually expecting over here is more or less Apple has already give a preempt to the market that this particular product launch is focusing on the iPhone 16. But however, during the product launch over here is that the senior management actually did mention that this iPhone 16 is actually not quite AI ready yet. That means, i.e., yes, you have the iPhone 16, the hardware, but the software upgrade to make it, we call it a fully run the Apple Intelligence, will not be ready this year in terms of their fully launched full product sort of this Apple Intelligence. And only in October, they will actually do it in beta testing. So what is beta testing in product form is still kind of a phase where there could be ironing out privacy issue, technical issue before this full suite of Apple intelligence, that means we've got the iOS fully capable in next year, somewhere around the first quarter of next year. That means, i.e., the full impact of this revenue generating iPhone AI capability will only start to trigger into the end of Apple bottom line, perhaps only in the later part of first quarter of next year and early second quarter of next year. All right. So with that, this is the particular interesting news flow and that has taken shape yesterday. And one thing I want to highlight over here is that given we start to see this kind of a correlated play that is taking shape, mean reversion rebound that is taking shape on the US stock market, and we also start to see a rebound in the US dollar strength as well. All right, so if you look at over here is in the FX market on a 5-day rolling performance basis, as we are speaking right now, the dollar actually rebounded across the board, and even the dollar that was worst hit against the Japanese yen, with the yen strengthening that we see about 1.5 weeks ago, the dollar now is trying to close this gap as well by actually shaping that mean reversion rebound on the dollar yen pair over here. So we see this bit of a correlation play in the absence of key macroeconomic data. That means what we are seeing right now, major US indices rebounding, it will lead to this rebound in dollar as well. And if we start to see a risk off in the major US stock indices spreading to the rest of the world globally, we do see the dollar weakness coming back into the picture, especially against the safe haven currency like the Japanese yen and the Swiss franc. All right. So, but this because this kind of movement takes shape in the absence of key macro data yesterday. And can this movement be sustainable? Later, I will share with you all in my intraday technical outlook session. All right, in today's daily dose. Okay, and in early today's morning, there's a release of some key Australia data. So let me open up the trading economics calendar chart over here. It seems to be that there's some technical issue that doesn't allow me to go into trading economics at this juncture. Okay, seems to be that that particular website is down as well. Not to worry, let me use trading view economic calendar. We also can find a very comprehensive economic calendar in trading view at the bottom over here. So just click on calendar and let me expand it. All right, it should be able to see. All right, it should be, yep. All right, excellent. Okay, let me load it first so that I hope that you guys could see my screen. Okay, let me try to put all the way up and let me expand it up. Okay, let me do an expansion so that you guys could actually have a bigger view. I think this should be the best. Right. Okay. Okay, let the screen load for a while. Okay, I think it's kind of hang a bit laggy at the point. Okay, let me. Okay, today's okay. Let me go up here. Okay, good. Okay, so what you see over here, right? There's this Westpac consumer confidence data that came in a while ago at 8:30 a.m. Singapore time. So it actually came in slightly what was recorded in the prior month at 84.6. It came at 85, and the business confidence, that's consumer confidence for Australia, and the business confidence was actually hit or inched down much more significantly from negative, reported at -4 from the previous one of +1 over here. All right, and we also do have the balance of trade figure that coming out from China earlier on, the export figure. So export was rather weak at year-on-year growth at 4.6% versus the previous month of 7%. All right, so that's for the month of August. So what we could see over here is that China, we know that since the start of this year, the economic growth of China has been primarily driven on the external economy through export rather than internal demand. As we know that internal demand, consumer retail spending, consumer confidence has been weak, and that has been pretty much evidenced in yesterday core inflation data that has slipped down for 4 consecutive months, which we have highlighted in yesterday's daily dose. And given the fact that the sole pillar of engine of growth has now started to slack as well, indicating that the external demand economy also getting weaker, and also primarily also driven by this US push for its airlines to slap higher tariffs on China products, especially on EV, which has been implemented in Canada and in Europe over here. And what we could see over here is their imports for sure has been weakened as well, 2.5% year on year from the previous month of 7.2%, slightly above expectation of 2%, also indicating a kind of a sluggish internal growth environment in China. That means because imports is related to internal consumption. So what we could see over here is that their internal dynamics or the internal demand dynamics in China continues to weaken. So we got to actually now take a very close eye watch on the near-term horizon right now in the coming months, especially we are now only less than we talk about 3 or 4 months more before 2024 ends. And given the fact that given such latest lackluster economic data out from China, very, very hard for us, for the China to meet its 5% 2024 target before 24 ends. And that could actually force China top policymakers to open up the taps to implement more expansionary fiscal and monetary policy stimulus. So so I'll be keeping a close eye on that if that could come up in any point in time this week or the week thereafter. All right. So that's for now for in terms of this kind of so-called key economic data release and their respective news flow that I'll share with you. Okay, so one particular we call it fundamental and intermarket dynamics that I'll share with you is pertaining more to the FX market regarding about the yen cross. So I do share late last week in one of my daily dose on Friday about the yen crosses. That means this yen cross pair is getting weak. That means i.e. potential yen strength coming into play, but that is more of a medium term dynamic. So we talk about a multi-week and multi-month time frame. So one particular call it intermarket dynamics and fundamental I share with you over here is to take into account of, okay, where was I? Okay, sorry, it's hanging over here. All right. So this particular what I'm showing you on the chart over here, this particular turquoise blue line, all right, you could see is a yen carry trade index. So what I did over here, I plot the G10 yen crosses, okay, G10 yen crosses, taking into account of Norwegian yen, SEK yen, CAD yen, Aussie yen, Kiwi yen, Euro yen, Sterling yen, Swiss yen, and dollar yen, and I divided by 9. So it's an equal weighted yen cross index. Put away, it's like an index that consists all of the G10 currency, but I inverted it. Okay, I invert it. So what you see, this inversion, what it means is that if this turquoise green line is going up, that means it's yen strengthening. Okay, yen strengthening. If this turquoise green line is coming down, that means it's yen weakening against the other currency. All right. Why I invert it? Because you're able to see it has a direct correlation or move in tandem with this bright red line over here. So this bright red line is in fact the ICE Bank of America US high yield index option adjusted spread. So think it as a proxy of the US high yield corporate bonds credit spread. Okay, so what is this credit spread? But this credit spread, right, is taking into account on the average what is the interest rate that borrowers will actually invest in you. Okay, put away that investors will, what is the rate that investors are getting on the average if they invest in high yield US corporate bonds minus off the return they'll be getting in the safest assets, which is the safer asset, which is the 10-year US Treasury yield. All right. So think about it that if this red line is inching upwards, that means it's the difference between the potential return investors could get in investing in high yield corporate bond minus off the potential return that investors could get in investing in a risk-free asset, which is the 10-year US Treasury yield. So if this line is inching upwards, that means the spread is widening. That means there is higher risk in investing US Treasury, investing US high yield corporate bonds. All right, and usually this spike up in the bright red line, which is this spike up in the high yield credit bond spread, actually move in tandem with the spike up in the JPY carry trade index. That means i.e. yen strengthening, view it as yen strengthening. And the spike up over here precedes a US recessionary period. All right, so this little gray kind of gray box over here is the recession period during the prior to the onset of the global financial crisis in 2008 and 2009, triggered by the US subprime blowout. All right, and what we see over here is that this little spike up in the credit spread also precedes the recession that was kind of triggered in the COVID pandemic period in 2022. And what's interesting over here, there was a spike up earlier on, then thereafter it died off. Okay, so this spike up in the credit spread happened in Jan 2022 and June 2022. So that was also the inflationary scare as well in US. Then thereafter, it actually continued to tumble. And recently, if you look at the credit spread, the pink line starts to actually shape a higher low, right? And this higher low now coincide with the push up in the JPY carry index, the inverse. That means indicating to us yen strength coming back into the picture as well. That means, i.e., if this credit spread continues to shape higher high and higher low over here in the next few weeks and the next few months as we head into Q4, and that could actually lead to a spike up in the turquoise blue line. That means, i.e., yen strength coming back into the picture. And if this continue, it could actually indicate to us that potentially the US economy may have already slipped into a recession, and that also doesn't bode well for those major US stock indices as well, especially those are heavily concentrated in the mega cap technology stocks like the Nasdaq 100 and the SPX 500, and also you could see potential negative feedback loop on the Russell 2000 and perhaps on the smaller scale by the Dow Jones Industrial Average, because the Dow Jones Industrial Average do have some significant weightage on some of the defensive sector like the healthcare stocks. All right, so this is something that I share with you from a fundamental and the intermarket dynamics that could take shape from a longer term horizon, multi-week to multi-month time frame. All right, so with that actually covers the intermarket dynamics session. Now let us shift our focus now to the intraday technical outlook or technical analysis outlook on the major cross asset classes. So with that, let me expand my screen first so that you guys could see. All right, over here. Okay, good. So let us now start with the FX market. All right, so as I mentioned earlier in my daily dose, right now we do see some form of dollar strength coming back into the picture. Okay, hopefully you guys could see on the screen. Okay, let us start with the euro dollar. So if you still recall, euro dollar yesterday we flipped to a bearish bias due to a latest short-term intraday bearish technical element that has been exhibited on the euro dollar. So the euro dollar within our expectation came down and hit the first support level at 110.26 over here. So with that, we will actually tighten our key short-term pivotal resistance for today at 1.1089. So as long as the price rebound, didn't actually surpass 1.1089. So that could be a rebound taking shape. Why? Because the RSI has already exited from the oversold region yesterday. And as long as this bounce didn't surpass 1.1089 for today, we will still maintain our short-term intraday bearish bias on the euro dollar for today on the intraday basis. A breakdown below 110.26 exposes the next near-term support level at 110 figure level for today on the intraday basis. Only an hourly close above 110.89 and the breakout above it will invalidate today's intraday bearish bias on the euro dollar to kickstart a kind of a recovery scenario for it to retest 111.40. Above it, potentially revisit the 23rd of August minor swing high area at 112 figure level. So that's for the euro dollar. So what are we expecting on the sterling dollar for today in terms of its technical configuration? Still recall that the sterling dollar yesterday, we do have a neutral level between 131.90 and this 130.75. It has really clearly broken down below 130.75 yesterday, and which is also the 20-day moving average. So with this breakdown of its lower neutrality level, we will flip to a intraday bearish bias, but do not forget price action don't go vertical down. And given the fact that the RSI starts to exit from the oversold level, there could be some form of minor bounce taking shape before further intraday weakness being reflected on the sterling dollar. So as long as this minor bounce didn't surpass 134.40, which is this minor congestion area over here, and if we do the Fibo retracement of the sell-off that was seen on last Friday all the way down to yesterday's intraday low, that also corresponds to the 50% Fibo retracement. So as long as this 131.40 short-term pivotal resistance holds in any form of any bounces that may take shape right now at this juncture due to the exit of its oversold level on the hourly RSI, we will flip to a intraday bearish bias on the sterling dollar. First near-term support level to watch on the intraday basis will be 130.40/130.10. Only a breakdown below 130.10 may expose the next near-term support level at 1.2940, which corresponds to the rising 50-day moving average. And bear in mind, the higher term dynamics, the medium-term uptrend still remains intact on the sterling dollar, given that it still continues to trade above the 50-day moving average, and the 20-day moving average is still above the 50-day moving average. For today, if the price action managed to actually have an hourly close above 131.40 and the breakout above it, then today's intraday bearish bias will be invalidated to see a kind of a minor recovery to revisit 131.90 and even the 28th of August minor swing high at 132.65. So that's for the sterling dollar. Turning our attention now to the Asia Pacific currency, which is starting with the Aussie dollar. So recall Aussie dollar yesterday, we do have a short-term pivotal support at 66.40 to maintain our intraday bullish bias. This support managed to hold yesterday, no change. And right now the RSI continues to shape a higher low after a former bullish divergence, indicating to us that last Friday's sell-off and yesterday's push down towards the 66.40 short-term pivotal support is losing downside momentum. So with that, no change. For sure, 66.40 will be our short-term pivotal support to maintain that intraday bullish bias on the Aussie dollar. First resistance level to watch on the intraday basis will be at 66.90. So let me put it in writing over here. Okay, 66.90 on the Aussie dollar. A breakout above 66.90 may expose the next resistance at 67.10, which corresponds to the 20-day moving average, acting as a similar resistance to it as well. Only an hourly close below 66.40 will invalidate today's intraday bullish bias on the Aussie dollar to see the Aussie dollar continue its impulsive down move to expose the next near-term support zone at 66.10/66 figure and potentially even 65.70 next, which is the minor swing low area of 5th of August, 9th of August, pardon me, and 15th of August. All right, so let us now shift our attention to the dollar yen. So no change on the dollar yen as it continues to shape that bounce above our short-term pivotal support that we highlighted yesterday at 14160/14140, which is also correspond to the minor swing low of 5th of August. Still maintain that short-term intraday bullish bias for this bounce to take shape. First resistance to watch will be at 44.30. Only a break above 44.30 exposes the next near-term resistance zone of 145.40, 145.90, which correspond to the downward sloping 20-day moving average as well. Only a breakdown with an hourly close below 141.40 will invalidate today's intraday bullish bias to kickstart another round of impulsive downward sequence to expose the next near-term support at 140.25. A breakdown below 140.25 sees 137.70, 137.35 next. So that's for the dollar yen. So with that sum up the intraday, we call it technical outlook on the major FX pair. So let me focus one particular FX cross pair that I want to highlight for you all for today will be the Swiss yen, the Swiss yen on the hourly time frame. So we know that the Swiss yen also continue to trade in a short-term downtrend and a medium-term downtrend as price action continues to push down below the 20-day and the 50-day moving average, and the 20-day moving average is below the 50-day moving average, but price do not oscillate in a single directional move. They actually oscillate within a short-term time frame, within a bigger trend. So what I could share in the short-term time frame, several key short-term technical elements is potentially advocating a mean reversion rebound. Firstly, price action right now managed to stall at the 76.4 Fibo retracement of that previous up move from 5th of August to 2nd of September at 168.20 level. And also very interestingly, the hourly RSI also now shaped a bullish divergence since last Thursday over here, indicating that the push down from 2nd of September all the way down to yesterday's Monday minor swing low is losing downside momentum, which also further reinforce a potential mean reversion rebound. So we'll be looking at this or using 168.20 as my short-term pivotal support on the Swiss yen. If this support level holds, potentials the Swiss yen may shape a minor mean reversion rebound to kind of revisit 170.44, 170.80 level, which is this minor congestion area, correspond to the 20-day moving average, acting as a resistance as well. And in terms of Fibo retracement of that previous sell-off from 2nd of September all the way down to yesterday's minor swing low, that also correspond to the 50% and slightly below the golden ratio of 61.8%. All right, only an hourly close below 168.20, a breakdown below it will invalidate this potential mean reversion rebound scenario on minor one, because it's an hourly chart on the Swiss yen to continue its impulsive downward sequence to expose the next support level at 166.80 in the first step, which correspond to the swing low of 5th of August. All right, so this is some thing to share on one of the FX cross pair, which is the Swiss yen. So now with that, let us now shift our focus to the major stock indices, starting with the Asia Pacific Index or indices, which is the Hong Kong 33 or the Hang Seng Index. So the Hang Seng Index continues to shape a bounce right above our short-term pivotal support that we highlighted yesterday, 16,690. Also now managed to trade above the 200-day moving average as well. So I do not want to put it so tight. This will be the 200-day moving average, I think, as a support at 17,120. So 17,120 could be the first support level to use to watch, but 16,690 will be still our short-term pivotal support to maintain this ongoing minor mean reversion rebound scenario that could be still at play in the Hong Kong 33 index, or the Hang Seng Index, as the hourly RSI continue to shape a series of higher low as it exit out from the oversold region and has yet hit the overbought region yet. First resistance to watch 17,330, which correspond to yesterday's lower limit of the gap down. A breakout above 17,330 exposes the next near-term resistance zone at 17,500/17,595 with confluence with the 20-day and the 50-day moving average that is acting as a resistance level, similar resistance level as well. Only an hourly close and a breakdown below 16,690 will invalidate today's intraday bullish bias on the Hong Kong 33 to see the continuation of this impulsive downward sequence to revisit 16,716 and potentially even 16,500/16,424, which is the minor swing low area of 5th of August and 6th of August. Okay, so that's for the Hong Kong 33. What's up next for the Nikkei 225, or i.e. the Japan 225? The Japan 225 managed to bounce and hit our first resistance at 36,540, and thereafter starts to trade in a tideway range in today's Asia session. So with that, we will have a Titan key short-term pivotal support for today, taking into account of yesterday's clear minor swing low that has been formed at 35,115. So RSI continues to be rather healthy, trading in a series of higher low, holding above the 50 level mark, and hasn't yet to hit the overbought region yet. All right. So with that, still some form of positive intraday bullish momentum that is still inherent in the Japan 225. So as long as 35,000 Titan key short-term pivotal support holds for today, 35,115, we will still maintain that short-term intraday bullish bias for this potential mean reversion rebound to play out above 36,540, exposes the next near-term resistance at 37,170 / 37,560, will also correspond to the 20-day and the 200-day moving average, acting as a similar resistance level as well. Only a breakdown of your hourly close below 35,115 invalidate today's intraday bullish bias to kickstart the continuation of the impulsive downward sequence to expose the next near-term support level in first step at 33,985, followed by 33,107. So that is the minor swing low area of 8th of August and 6th of August respectively. Okay, now shifting our attention to the German 30 or the German DAX. So the German 30 has almost hit our first resistance at 18,470, which is the 20-day moving average as well, before shaping that sideways movement in today's during the US session. All right. So with that, we'll be using yesterday's minor swing low, a clear minor swing low, as our Titan key short-term pivotal support for today. 18,255. So as long as 18,255 holds, still maintain that intraday bullish bias for this mean reversion rebound scenario to play out. Next resistance level to watch on the short-term basis, 18,660. Above it exposes 18,820 next. All right. Only an hourly close below 18,255 will invalidate today's intraday bullish bias to kickstart another round of impulsive downmove sequence to expose the next near-term support zone at 18,160 / 18,075. Below 18,075, may see a further slide to retest the all-important 200-day moving average. They're also confluencing at the graphical support at 17,820. So that's for the German 30. Right now, let us turn our attention to the major US stock index or indices, starting with the US Wall Street 30. So the US Wall Street 30 managed to bounce and hit our first resistance zone that we highlighted yesterday, 41,040 / 41,200. So given that the RSI has already exited from the overbought level and is now inching downwards with a lower high, so potentially the price action of the US Wall Street 30 may now see a slide right now, given yesterday's sharp push. So first support level to watch will be at 40,580 level over here. So I don't want to put it at 40,580, is a bit tight. So still using yesterday 40,140 short-term pivotal support level, which also correspond to the rising 50-day moving average and as well as the lower limit of this minor ascending channel that I drew from the low of 6th of August that managed to survive on last Friday's sell-off. So as long as 40,140 short-term pivotal support holds, we will still maintain that short-term intraday bullish bias on the US Wall Street 30. Above 41,200 exposes the next near-term resistance at 41,535 that has been capping its prior strength or prior rebound since 29th of August. Only an hourly close below 41,140 will invalidate today's intraday bullish bias to kickstart a continuation of this corrective down move sequence to expose the next near-term supports level at 39,867, followed by 39,580, which is this minor congestion area here from 9th of August to 13th of August. All right, so now let us now turn our attention to the Nasdaq 100. So as for the Nasdaq 100 over here, price action also hit that first resistance zone that we highlighted yesterday, 18,680 / 18,800, but price action on the RSI hasn't hit overbought level yet. So potentially over here, there could be some, because it hasn't cleared above this level. So we do not want to put it so tight on the short-term pivotal support level. So first support level to watch out for potentially could be yesterday's US session low, US second half session low at 18,000 490. All right, so using yesterday's clear minor swing low, which corresponds to the 200-day moving average as well at 18,320. So 18,320 short-term pivotal support level holds, we will still maintain that short-term intraday bullish bias above 18,800 potentially exposes the next near-term resistance level at 18,935, followed by 19,117. Only an hourly close below 18,320 will invalidate today's intraday bullish bias on the Nasdaq 100 to kickstart another round of impulsive down move sequence, exposing the next near-term supports in first step at 19,960, followed by 17,750 next. All right, so that sum up the intraday technical outlook on the Nasdaq 100 as well as the broad-based benchmark stock indices. So with that, let us now turn our attention to the commodities market over here, starting with gold XAU/USD. So for gold XAU/USD, no change as price action continues to hover between 2,532 and the key short-term pivotal support at 2,473. So you're still using the 2,473 as my short-term pivotal support. Still maintain that intraday bullish bias within this range configuration that is in place since the all-time high area of 20th of August. So price action now got to break above 2,532 for sure to kickstart an impulsive up move sequence to kind of see the next near-term resistance zone to come in first step at 2,588/2,595. Only an hourly close below 2,473 will invalidate the intraday bullish bias to kickstart a minor corrective decline sequence to expose the next near-term support zone of 2,435/2,415, which confluences with the rising 50-day moving average as well. Okay, so that's for gold XAU/USD. Lastly will be this West Texas crude oil over here. Okay, let me open up the chart of this West Texas crude oil. Yes, so West Texas crude oil, no change. Yesterday, we flipped to a intraday bullish bias for a mean reversion rebound because it has already met the lower limit of this minor descending channel that is in place since the high of 18th of July. So no change, still using this 68,020 6820, pardon me, as my short-term pivotal support level. Still maintain that intraday bullish bias on West Texas crude oil for the potential mean reversion rebound scenario to play out. First near-term resistance to watch will be at 7,115. A breakout above it, revisit the former major symmetrical triangle range support now turns into a pullback resistance at 7220/7315. Only an hourly close below 6820 with a breakdown below it invalidate the mean reversion rebound. That means invalidating today's intraday bullish bias as well to kickstart another round of impulsive downward sequence to expose the next near-term support level at 6755/67. A breakdown below 67 potentially may see further weakness towards 6510 next. All right, so that's for the West Texas crude oil. So other than that, what are the key economic data to take note of for today? Okay, let me share with you all the economic calendar. So for today, during the European session will be rather quiet. We do have the inflation number, final inflation number out from Germany, so that shouldn't be a big surprise as well. Some job data that's out will be United Kingdom, UK unemployment rate. Then during the US session will be rather quiet as well over here. So what's interesting over here in tomorrow Asia session, we do have two key Australia event to take note of. Will be at this 8:30 a.m. Singapore time. We have one of the RBA officials speaking. RBA Hunter will be speaking, and also Australia will also release a consumer inflation expectation data that'll be out at 9 a.m. Singapore time. And 9:30 a.m. We do have a Bank of Japan official speaking, Nagagawa speaking at 9:30 a.m. Singapore time. And do not forget, over here in tomorrow morning at 9 a.m. Singapore time, we do have the very first US presidential debate between Harris and Trump, and that could potentially be the last physical face-off between two of them before the US election takes place on 5th of November. And what's interesting over here is, let me do a quick refresh. Ahead of tomorrow's it's live, it's not recorded, live presidential debate, president nominee debate between Harris and Trump. at this moment in time, based on this real clear politics betting average, taking into account the average of the various betting sites that we call it the betting market, Trump now has a slight lead over Harris at 52 versus 46.8, and this lead could change as tomorrow's live debate takes shape. And bear in mind, do not forget, Trump at this point, at this juncture, tend to kind of be more advocative of pro-business taxes, whereas Harris tend to advocate more on the middleman. All right. So if Trump continues to lead over here, that could actually represent Trumponomics 2.0 may come back into the market again, and that could actually favor U.S. corporation, which could be positive for the Dow Jones Industrial Average and as well as the Russell 2000. All right. And what's market participants will be pretty much a key concern about how forceful Trump wants to push out his very aggressive protectionism trade policy, because in terms of timing wise, that could potentially be detrimental to risk asset as well, because we know that if we do have a China trade war 2.0, that could see dollar strength coming back into the picture, and potentially that could see a sell-off in the market as well. But that could only take shape depending on how Trump want to actually time his policy. I mean, he can't have two policies coming out at one go. One being pro-business, which is his corporate tax cuts, and one being detrimental to the U.S. economy, potentially due to the protectionism trade policy that he advocates. So during the live debate, he may be asked which particular policy that he wants to actually deploy first. And also good to hear from Harris' point of view as well, because Harris so far has been pretty much silent of her predecessor Biden tiering tariff system approach towards China, because before Biden dropped off the race, Biden actually proposed trade tariffs on China, but not of a blanket basis, but more of a product-wise basis. That means, i.e., he do have a higher tariffs on China-related semiconductor products, EV products, but lesser on other China products. So I believe that the moderator will be quiz Harris on her view of her predecessor tier-based tariff policy towards China, because so far in her we call it public speeches, she has been pretty much quiet on this approach. So something to take note of as the live debate takes hold during tomorrow morning, starting at 9 a.m. Singapore time. So with that, that sums up today's Daily Dose of Market Insights. I'm Kelvin here, signing off, and we shall speak again tomorrow. Thank you.